Hello, my name is Vinay Nadkarni from Clearbridge Investments, and I'm proud to be hosting this large cap growth strategy update with my colleagues, co-portfolio managers, Margaret Vetrano and Peter Borbell. As a reminder, Clearbridge is an authentic active manager solely focused on fundamental equity management, providing concentrated but balanced equity solutions that are differentiated from passive and factor-based strategies with ESG integration across our investment platform. We now manage $177 billion in assets across our equity platform as of year-end. In the no good deed goes unpunished camp, we usually do these calls midweek around noon Eastern time to allow all time zones in the U.S. and the many clients we have in Europe to dial in and do it the week after our holdings and attribution post. So of course, when we planned this with good intentions, we ended up going head-to-head with the inauguration events in D.C. today. So we thank you, all of you, for dialing in live for this strategy update today. Our format will be moderated Q&A with some initial questions, and then you can submit your questions via the chat feature in this web format. We'll try to get through as many of those questions as possible, and we'll follow up with our client representatives one-on-one with any questions we don't get to in the allotted time. Maybe a good place to start is to give an overview of the long-term objectives of our strategy and how we try to be differentiated from the marketplace and our peer group. Margaret, maybe you can kick us off and give us an executive summary format of kind of what you guys try to accomplish in the large cap growth strategy.
Sure. Thanks, Vinay, and thanks everybody for joining today. Just to set the stage for the large cap growth strategy, when Peter and I think about our goal with the strategy, it's to create a portfolio that strikes a balance between being purposefully different from our peer group and the index, the Russell 1000 Growth Index, where we think we can add value over time. But also, we want to be diversified enough so that hopefully what you see from the outside looking in is that of a consistently compounding portfolio through a business cycle. How do we achieve that? Those two goals of diversification and concentration. First and foremost, I would say we work closely with our analyst team to find ideas that we think can compound well over time. Whenever I say a great business model, I always think about Visa because it's just a business that has a great secular tailwind as people use more plastic and less cash. It's highly profitable. It's a duopoly. There are barriers to entry. It's the kind of business that I think we can own for multiple years. Our turnover in the portfolio is 15 to 30%. That's a target. That's the output of finding good businesses like Visa that we think we can own for years. Second, we believe that having some valuation sensitivity helps us manage risk. We fundamentally don't believe we have to own any stock at any price. It's not uncommon for us to work on a company and find that we don't necessarily see anything that's not fully valued in the stocks today, particularly in this market. And so we tend to be more patient investors, and you're more likely to see us buy names or add a new name amid short-term volatility. Lastly, I would say within the context of a concentrated portfolio, we only have 40 to 50 names in the portfolio. We want to have different kinds of companies. We call them our buckets of growth, cyclical, stable, and select buckets. But the point of the buckets is that we want the portfolio to have companies that have different drivers. This is not an internet fund. It's not a reopening of the economy fund. It's not a healthcare fund. It's a diversified fund. Within all of this context and thinking about that, I think it should make sense that the portfolio tends to do well in a low growth environment. A combination of the stable and select buckets that you can see tend to help us perform well in a low growth environment. It also tends to have pretty good protection in the down market. You saw that in the fourth quarter of 2018, where we outperformed substantially as the market faced some headwinds. And you saw it during the period from February 19th to March 23rd in 2020, when the market sold off amid the pandemic. The portfolio does tend to struggle more in a beta-driven, higher momentum-driven market because of that diversification and because we purposely have different kinds of companies in the portfolio.
Great. So Peter, I'll go to you for a recap of 2020 high level from your perspective. I mean, 11 to 12 months ago, we thought COVID was more of a regional or non-U.S. phenomenon. I think that Margaret was actually in Europe in mid-February. And we had a true global shutdown for close to a month in March, April. Yet the Russell 1000 Growth had its second best year in history, just short of 1998's results. It was up 38.5%. Why do you think there was such a separation of the real economy real economy from the stock market last year.
Yeah, great, Vinay, and thanks again for all those participating. I know we're competing with Biden as we speak. Last year was certainly unique. What I would suggest is this was almost 100% liquidity driven. This is different from the great financial crisis that most of us remember, in the sense that the Treasury and the Fed stood up programs that were orders of magnitude larger than the great financial crisis. It was bipartisan, right? If you all remember, TARP and other programs, it took 3 tries to get through Congress. This was completely different. I think it was clear that everybody realized the severity of the problem, and they threw an enormous amount of money, whether it's the repo market, whether it's the mortgage market, and the Fed is arguably fine with inflating asset bubbles, right? They've always said this. They'll deal with the consequences later, but at this point, right, it's pretty clear. And even if you listen to incoming Treasury Secretary Yellen yesterday, this is a pretty dovish Fed and Treasury, and they're going to try to keep the pedal to the metal for as long as they can. Now, the other thing is growth always does better than value in a big economic drawdown, right? Last year was huge negative GDP. People pay more for the scarcity of growth. I think where Margaret and I maybe got it a little bit wrong is just we underestimated the definition of the breadth of growth and the move. But like I said, if you listen to Powell, if you listen to incoming Treasury Secretary Yellen, they understand the severity. We like to maybe not call this stimulus more than we call it life support, right? Because this isn't an accelerator for the economy. This is trying to keep businesses and individuals afloat, and I think that's a differentiation that is probably not properly thought well out. Aside from the tragedy, I will say that there were plenty of winners, right? You look at the work from home phenomenon, you look at those that were positioned from a lockdown perspective, whether it's Thermo Fisher with their various verticals within healthcare. Peloton is an easy one. They, not to be glib, but they got super lucky with the timing of their IPO. Costco and Amazon, right? Now, these are durable businesses that are going to successfully participate in any version of reopening. But there were a lot of pull forwards. The SaaS companies within software, as you look at some of these long tail assets, a lot of business was pulled forward. And another empirical proof point is if you look at retail sales and you compare it to the great financial crisis, just use this metric alone. In the great financial crisis, it took 3 years for retail sales to eclipse the pre-drawdown. In this scenario, it took 60 days for retail sales to eclipse pre-COVID. And I guess what I'm suggesting is, the amount of money that was filtering through the system and the backstop that was provided was unparalleled. We hope we don't have to go through this period again, but truly unparalleled at the amount of liquidity that was thrown into the wash right here. And so if you put all this together, what we would suggest is that rates have a disproportionate effect on the terminal value of long tail growth stocks. You pick it. We all read about it. It's all over CNBC. That's why they went and continue to go parabolic. The art is going to be balancing things from here as we have successful vaccines, as we have a gradual reopening. I think that in 6 months, the world, through the lens of the equity market, is going to look substantially different. And then just lastly is just the speculative element is the highest that I've ever seen. I'm entering my 29th year in the business, and I'm seeing things I've never seen. Single stock option volume, flows into the most speculative ETFs, right? Eclipsing, guys like Vanguard that sell 2 basis point S&P ETFs, right? The pricing of IPOs and the performance subsequent to that, the fundraising for SPACs, pre-revenue companies trading at 40 billion market cap. There's a long list of things that kind of put us on the put some of these data points on the worry side of the ledger. But there's a lot of things that contribute to this kind of outperformance, like I suggested, and we'll get into this in some more depth, but the second half of the year might look a little bit different than what's been going on to date. So, Vinay, let me throw it back to you.
Great, Peter. So, Margaret, maybe to tie to your kind of nice summary at the beginning, we've talked, I think, eloquently to clients about the balance of growth and what that means from a performance expectation standpoint. And Peter talked about it, right? I think the interest rate environment has really put a lot more value on the terminal value. And now you have where 30% up years are going to be challenging for this strategy, but we now have 3 of the last 4 years where the growth index has been above that magic level. So maybe how would you position to the listeners here kind of your evaluation of recent performance and any lessons learned, and maybe to dovetail off of Peter's comments, what you think will be the conditions that'll be for the strategy going forward?
Yeah. So in terms of our performance for 2020 and as we grade ourselves in terms of how we did in 2020, if you had told Peter and me in January that the Russell 1000 growth would be up 30% in 2020, I would say we'll have trouble keeping up for exactly the reasons we just discussed, because those buckets of growth and the limits we put around how much momentum we will own in the portfolio will constrain the portfolio's performance in a market that's that strong. That's certainly not meant to be an excuse for us to trailing the market in 2020, but it's a recognition of the way we construct the portfolio to be diversified and to perform well through the business cycle, so in the up markets and the down markets. If I look back at 2020, I think one clear thing that we did not expect and we were not positioned for was the resilience, particularly in technology. If you look back at past economic downturns, tech spending has always been cyclical, and it made sense to us as we thought about the pandemic and the repercussions of the pandemic in the first quarter, that we knew SMBs were going to be struggling. We knew that big sectors and big consumers of tech, like travel and leisure sectors, were going to be under stress, and we thought that, just like in the past, they would delay non-essential projects or things without a very fast payback. We did see some weakness in the beginning, but the pull forward of digital transformation and security spending was just so much bigger than any kind of deal push-outs. In fact, if you look at the third quarter of 2020 results, 94% of tech companies in the S&P met or beat tech earnings. That's an astounding figure. Historically, the average for the overall market's more like 72%, 70%. So it's very, very, very strong. I think that was one thing that we didn't expect at the time, and certainly that was a learning for us. We did during the back part of 2020 make some changes to our tech positioning, so we did add as it became clear that particular segment was going to be more resilient. In terms of what conditions would be good for the strategy, I would say market returns that are more in line with historical averages. So think plus or minus 10%, low GDP growth kinds of markets, returns that are broader. So not just a small number of stocks performing really well, but markets where you have a broader number of stocks really driving stock performance. That would tend to be better for the strategy. And I certainly don't want the market to have a pullback, but I would remind you that historically in market pullbacks, we do tend to fare better than our peer group and better than the market because of that diversification, and because we do have some holdings in the portfolio that are there for just that purpose, to act as defense.
So Peter, let's build off of Margaret's comments there. And you've had great mentors that have told you, a good part of successful investing is pattern recognition, and a good part of it is looking forwards versus looking backwards and recognizing new trends. That's why you guys don't use quantitative screens in your process. I mean, why do you think, if you look at this slide, why do you think it's so rare for tech to be the leader going into a rally, to be the outperformer during that downturn in March and February and March, and then be really the runaway leader here in the recovery in the back half of 2020?
Yeah, no, it's a good question. Margaret touched on it briefly. It's rare that a single asset class or vertical can become offensive and defensive. And to your point, tech was was just that. I think you need to separate parts of tech, right? So on-premise was kind of a semi-disaster, but those that have optimized their model, right, to use a subscription basis had a lot of business pull forward. Tech has always been cyclical. I think it'll continue to be cyclical, and we even saw that in some of our portfolio names, whether it's Salesforce or Splunk, that is optimized for a kind of a SaaS model. We're talking about, pencils down, budgets getting scrutinized, and so forth. And so there was some semi-collateral damage with the fact that people were scrubbing budgets more than they were. Maybe the slight difference is that whatever digital strategy a company had, it was vastly pulled forward, right? You're gonna sunset your Cisco routers, right? Your F5 load balancers or whatever it is, and you're gonna make this switch to the cloud even faster, right? That's what a lot of companies said. You pulled 3 years worth of demand into a couple quarters, and then you kind of look at the business model, right? The ultra long tail, and you apply a zero interest rate to it, right? The terminal value just explodes, right? We grew up in a world, albeit with slightly higher interest rates, where any software company trading at a 10 multiple of revenue was viewed as elite, right? Certainly exclusive, right? That was the domain of Salesforce and Adobe when they were killing it, right? When they were growing 25 to 30% per annum for a decade. What you're seeing now is a new batch of names that are growing maybe slightly faster, but in the range, that are trading at 30, 40, 50, and in some cases 90 times revenue. And the assumptions that you have to make to underwrite a new name at that valuation, right, is the only thing you can attribute is just interest rates. And that's a difficult bet to make, I would say, on a go-forward basis. You think about our base case today, Margaret and I's base case is because of successful vaccine, right, because of the ingenuity at the consumer and SMB level, second half of this year, we will get a broad reopening. You will have broader economic growth. You will have pricing power, right? You will have commodity reflation. All of this is natural coming out of a deep recession. That does have an impact on interest rates, and we'll see what ends up happening to the most expensive arm of the most expensive sector. And it's not just exclusively within tech, but that's where a lot of these names seem to fit, right? People will get out. You're going to go to your favorite restaurant, to your Ulta for skincare, and you're going to go to Disney on a family vacation. You're going to visit grandparents. This is going to have knock-on effects to the broader economy. And just from an asset allocation perspective, those that are super overweight a lot of these exclusive, expensive tech names, will be looking for alternatives. And so, to Margaret's point, looking at discretionary, looking at healthcare, looking at areas that have lagged, are going to be that does. And healthcare has become discretionary, maybe for the first time as your out-of-pocket has increased. But these are areas that we think are going to have probably better risk reward, and that's what we're looking for in terms of new ideas. Now we don't have our head in the sand. We understand that a lot of what's happened is going to be permanent, right? The work from home phenomenon, corporate travel, real estate, a lot of knock-on effects here as well. So we're processing all of that as well, and making sure that we're not too overweight the reopening, because there will be some lag effects there. So, Vinay, let me throw it back to you.
Yeah. So that's great about, I think, kind of an overall backdrop. Let's dig up into one of the things that I think has been the highlight of how you message the strategy, and that's really around the portfolio construction. So Peter, I'm going to go back to you on this one, because I know this has been a topic you've talked about many times on these investor calls, and that's really the concentration of the largest names. You can see here from how it's evolved from 2014 to where you have the top three names, Apple, Microsoft, and Facebook, really at 30%. Apple put on $1 trillion of market cap in 2020. How are you and Margaret navigating this challenge, and maybe walk through the repositioning of this part of your portfolio during the year?
Yeah. It's been a little bit frustrating to see, multiple expansion really take the lead in terms of performance. Like Margaret and I have no problem losing if we make mistakes, but losing because companies go into the ether because of multiple expansion has been frustrating, right? We've talked about this, Vinay. It took Apple 40 years to get to its first trillion in market cap, and it took 45 days to get to its second trillion in market cap. That's not normal, right? Tesla, irrespective of kind of what they do for a living, going up 700% with almost no change to estimates is frustrating. But what we have done, and again, we Margaret and I are running with some concentration variables here, is we are looking at reallocating a lot of this large market cap budget and deploying them into different types of names. You had mentioned a couple, or we're going to dig in probably a little bit deeper into things like ASML in semicap, which is a near monopoly in all of tech. Atlassian, which is the Sydney-based workflow company, NXP and Aptiv that are indexed to this large movement towards EVs. Alta, I mentioned a concept that will show a great results in an omni-channel fashion in the second half of the year. Alcon in eye care, Amazon. It's the only name that we have actually added to in our top 5. You look at the fact that there's been no separation. We think that the second half will start differentiating business models, right? Facebook and Amazon. If you look at the PE gap to the S&P, it's the lowest it's ever been, right, since these have been public companies. So there are opportunities, I think, even within the kind of the top 5 where we are actually adding to positions, Facebook and Amazon, and it's kind of scratching our head on a few of the others. But we are going to use a lot of this market cap and tech budget to add active exposure. And we're content being underweight some of these names like Alphabet, Microsoft, and Apple. We think we can do better on an absolute and relative basis on a go-forward basis. So these are the kinds of things that you've seen. You're going to continue to see that, and these are our business models that we think can grow into the next platform type of company in many cases. So let me throw it back to you.
Great. So Margaret, I think the second part of that portfolio construction, and maybe we'll actually go back to slide 5 here with the buckets, but the other driver beyond the FANG stocks or the mega tech stocks have been what you call dream the dream stocks, right? That have truly moonshot this most recent year. I think nothing typifies this phenomenon more than Tesla. Can you talk about how a valuation sensitive, less momentum oriented manager like yourself, but that is relative risk aware, is navigating this landscape, and does this force you to look at least or consider a wider opportunity set?
Yeah, you're right. Tesla has been nothing short of amazing this year. I would just caveat, and I would say that Tesla, if we owned it, just to be clear, would be in that select bucket that you can see on slide 5. We are absolutely willing to own innovative companies, but I think to your point, Vinay, our valuation sensitivity makes us want to put numbers around it. And that's what we mean when we say we're not really dream the dream investors. We want to understand, okay, we love the secular growth story. Now show me the money. Tell me how I make money. And how this company's cash flows and returns are gonna grow over the next couple of years. I don't think we make emotional buys. We make what we think are rational buys, and we buy what we think are good long-term trends. So we don't own Tesla, but we do own Aptiv and NXPI, which make some of the parts to enable EVs in a broader range of cars. We have not owned Netflix, but we do own Disney as a company with a bigger library and with decades of history of creating content that they're also pivoting to an OTT model. More than a third of the portfolio companies that we own, we would characterize as high growth innovators. So, when we talk about diversification, we of course want to own some companies that are that more momentum oriented. We just want to have balance in the portfolio. names like NVIDIA. It's a chip company that has a terrific position in the video game market, but it also makes chips that help enable artificial intelligence and machine learning functionality in data centers. Peter mentioned before, we recently added a position at Atlassian. That's a maker of collaboration and workflow software. It's very well positioned for the way we're working today and the way we think we're going to be working over the next several years. Again, getting back to that valuation sensitivity that we talked about, we've been looking at that company, Atlassian, for a while, and we bought it amid a short-term disruption in the stock price because they're moving to a subscription-based model. So, we watched it and we waited, and I think we bought it at a really advantageous price. Just to talk about the elephant in the room, it's always important for Peter and myself to look at what we got wrong and how we can improve going forward. And when we think about Tesla, when we thought about Tesla in 2020 amid the pandemic, we expected that company to be negatively impacted by the downturn in the auto cycle. We thought it would put significant stress on their cash flow given their high working capital balance. They ended up being more resilient than we thought, and I think rapid advances in battery technology have accelerated adoption of EV technology in general. We do think here the stock discounts in that it retains a dominant technology and market share leadership in EVs for decades to come. And we think that's aggressive considering that there are efforts to gain share in EV by Volkswagen and GM and Rivian, et cetera. So, we think that the EV market is an interesting one, and owning companies like Aptiv and NXPI is a diversified way of playing that longer term trend.
Let me ask you a question we just got in from a longtime Greystone client of ours that just asked about, right, if we go to the buckets knowing we have some of these, we've articulated, the ranges that we have. Are there any frustrations of how either each of these buckets have behaved during 2020, or how within that bucket some of our stocks have behaved that you would point out into the listeners kind of dialed in? I'll open it up to either of you. Who wants to take it first?
Maybe I'll take that. Go ahead, Peter. You go.
No, go ahead. Go ahead, Margaret. I'll follow up.
Sorry, we're both too polite. I think in terms of our select bucket, the stocks performed well. It wasn't that the stocks didn't perform well. It's that the market, the RLG has more like half of the index is in that select, what we would call select bucket. It's more momentum oriented than the index is more momentum oriented than our select bucket, which is closer to mid-30s kind of % of the overall market. Our cyclical bucket actually did perform very well. Qualcomm and Alcon, you could see on the slide, but TI and XPI, those companies also performed quite well. I would actually say it's more the stable bucket of names that were more ratable performers, and certainly that whole group of stable names was not up on par with the overall market.
And I would just add, this goes back to one of my original comments, that ETFs have had a kind of disproportionate effect on just the idea that all these names track and travel in a group, right? These are monoliths, right? There's very little separation in business models, right? In other words, what they do for a living, even though the majority of the top 10 tech names are frankly playing for very different results with very different kind of end markets. So that's the part that continues to frustrate, is there really hasn't been a separation, and that's part of what Margaret and I are working through today, right? You look at Amazon, and just by squinting a little bit, right, you can appreciate the fact that you've got some high revenue sources that are translating into pretty meaningful earnings growth and cash flow growth. The AWS business is probably underestimated in terms of the longevity or the duration of growth there. The advertising business is still in its infancy. They frankly have no idea what they're doing, but they're getting it better and they're getting it right. And so that's got huge it's got huge room for continued market share in online advertising from maybe even guys like Google. So there are things that this market, I think, is presenting, and that's the hope, is that we're gonna start differentiating business models, and like I said, we're taking a lot of our tech budget and starting new positions or adding to positions in some of these very unique companies that do have the hallmarks of giant platforms in the future. And then just lastly, just to solidify Margaret's points on whether it's 5G phones or the movement to EV, right? We've got lots of participation there. We're just not doing it with many of the kind of the name brands that you would think through.
I think another question that just came in, right? So much of what people are thinking about with growth investing seems to be around technology, and we've talked about that for a bit. But a lot of your repositioning, either recategorizing names or adding to names in 2020, was in that opportunistic bucket. You'd mentioned Alcon and those type of things. Maybe it's just helpful to walk through, and I'll go to page 7 about some of those names that you guys did and how you're thinking, because I do think that differentiates you from a lot of growth managers having this kind of opportunistic bucket. I've heard Michael Goldstein talk about playing the sides, at the expense of the middle right now, and you clearly, I think, have this other area with the opportunistic bucket that I think a lot of other growth managers, don't have. So maybe just your guys' thoughts, and maybe Margaret, we'll start with you on just your thoughts on that part of the portfolio right now.
Yeah, the question that we often get is, what about growth to value and that switch? And I would always say, I'd kick it back to you and say, we don't think about growth to value and the stocks that we own and that we've been interested in lately and that we've added to the portfolio. It's more about reopening versus momentum. And to your question, Vinay, some of the names that we own in that cyclical bucket are more trades around reopening. So, NXPI and Alcon. So Alcon, both of them are names that have secular growth, but they also have cyclical growth. And I think that there's a good opportunity here to, as a valuation sensitive investor looking for good ways to add value into the portfolio, owning some of these other names where we think that there is real good cash flow growth and earnings growth ahead for some of these companies that have a little bit of cyclicality to them as well, that we can really add to the portfolio and really add some diversification. So if you look at that cyclical bucket over time, it has helped us perform well when you have changes in market leadership. And I think the reason for that is that some of the drivers to names like an NXPI or like an Alcon. So Alcon, part of the business is depressed because people are going into hospitals less for cataract surgery. Okay, but it's not that people who have cataracts are no longer going to have surgery. It's that there's an ephemeral issue that may mean that there's some short-term disruption, but they will still go and have that surgery. And so as we look out over the next several years for that business, we think you can get really good growth and growth with a different kind of driver to it than many of the other things that we own in the portfolio. And so it really, the cyclical bucket has helped us add diversification to the portfolio so that we can do exactly what we said at the very outset is our goal, which is to try to perform well through different kinds of business environments.
Great. So why don't we take a slight pivot and just talk a little bit about more the regulatory impacts on some of the fundamentals. I mean, we've gone a half an hour on this call and really mentioned what used to be viewed as a bellwether growth sector, which is healthcare. So maybe, Margaret, I know you've reduced a lot of your biotech exposure over the last few years. Some of that is through acquisitions, and some of that is just selling some names. But you've also had great success in some of the compounders between Thermo Fisher that Peter mentioned before, United Healthcare, Zoetis. So just, what are your current thoughts on the space overall and the regulatory landscape and the potential impacts on the fundamentals for healthcare?
Yeah, it's interesting that we haven't talked about regulation much in the first 30 minutes. That may change after we have the switch over in Washington. We'll see. But yeah, I think some of the issues in biotech and managed care over the last 5 years were really a function of sentiment in Washington and fears of legislative changes that could affect the profitability of healthcare and biotech companies. You know, Zoetis is a name that we own, that we've owned for a while, that's actually been a fine performer, but they make treatments for companion animals and food source animals, so they were sort of out of the way of that controversy. I would say that the conversations around drug pricing and healthcare affordable, from what we know so far about the new administration, those are going to remain topical. So I wouldn't say that it's no longer an issue, period. But we also think that one point that's been evidenced by the pandemic is that the U.S. needs a vibrant healthcare ecosystem. We need innovation by pharmaceutical companies to develop vaccines and other treatments for unmet medical needs. We need companies to help manufacture and deliver testing equipment and protection equipment. We need managed care companies to help provide healthcare. And our hope is, and we're starting to get a sense that this may be the case, but healthcare seems to have a little bit less of a target on its back now than I probably would have said 3 to 5 years ago. So, you know, we are less overweight than we have been in the past, but certainly if we found the right opportunity in healthcare, it's not something that we would shy away from because of regulatory concerns.
Peter, I know this topic of how regulatory policy affects companies is something you spend a lot of time thinking about, and we talked about it earlier a little bit, but really not about the regulatory element, right? It does feel like we're at a moment in time where the target on the backs of these mega cap companies and the power that they wield seems to be just growing across party lines. So I just wanted to ask the same question of what you think are less your predictions, but more the things that you're paying attention to as far as the regulatory impacts that you could see in technology going forward.
Yeah, it's a fair question. I would say, there's a reason Google's up 5% today, and that's rumors of Biden's pick for antitrust. And point being is that let me just go back and just add one thing to what Margaret had mentioned, just in healthcare. Everybody wants to break the back of healthcare. It's a giant spend within all of GDP. And so a couple of years ago, Berkshire Hathaway, JP Morgan, and Amazon launched a very aggressive initiative to say, can we do better, right? Where are pockets where we think we can kind of bust the quasi-monopoly and so forth. And I think most of you saw in the last couple months that JV has extinguished, right? These guys, smart, 150 people, looked at the kind of the framework of how healthcare is delivered and said, yeah, we can't do anything about that. It's too ingrained, it's too important, it's too personal, right? Healthcare is very personal. We can't do much to change kind of how that is delivered. It's going to be interesting in the tech discussion as well, right? Because a lot of the front-facing, local state AGs or antitrust or DOJ in the federal government, right, are approaching litigation using antiquated resources and letters of law, and that's why. And let's be clear, right? The greatest litigators and attorneys certainly don't work for the government, right? They work for private companies, and so this is going to be long, drawn out process. It's clear that this will take a decade. You're hitting this thing from kind of different angles, and when I say this thing, right, you had Europe take it one direction. You have the U.S. trying to use a watered down version of Europe's GDPR, for instance, right? You've got China that effectively bludgeons you, right, by having Jack Ma disappear for a couple months and take targeted shots at Alibaba and Alipay. So this is bipartisan. It's going to be with us forever. The burden of proof is going to be extremely difficult, right? The genesis of antitrust is, does this hurt the consumer? And it's very hard to see how these business models really do hurt the consumer when you can opt in or out. And we follow it closely. There's no question. We are always looking to see if there's an investable edge that we have. and we study this. We use a lot of third-party resources. We've got a great internal analyst that's on this, and it's almost her singularly highest focused job. So we like I said, we haven't come to any great conclusions other than that this is going to take a lot of brain power, a lot of money to litigate, and it's not clear that the desired solution is ever going to be in place. And so we continue to own those platform companies where we feel there's not just a competitive advantage, right, but there is this will to innovate. And you know, they will sunset businesses that they think are impacted as they kind of create new ones. So this kind of becomes self-fulfilling. And we've also never operated at this kind of size and scope where you're touching billions of people on every given day, right, in terms of posts or news feeds or whatever else it might be. So this is an ill-elegant way of approaching, you know, the new way of news discovery, and I just think it's gonna be a long, drawn-out process with solutions that won't be applicable or needed in the next 5 to 10 years.
So why don't we tie this all together, Margaret? From your perspective, what's the focus of you and Peter working with the analysts on idea generation? You know, and what are the current biggest risks you see within the current portfolio?
Yeah. First and foremost, I would say we're always looking for good platforms that we think we can own for several years, and you know, there tend to be a smattering of those across tech and healthcare and all sorts of sectors. But just by sector, we've been spending some time on consumer of late, thinking through two questions. Peter touched on this a little bit, but we own some names that have clearly benefited from COVID, and so we've been going through those names, trying to decide whether COVID was a blip, kind of a one-time boost, or whether the benefits from COVID will be a more durable benefit. So Amazon it's just a good example. I think Peter mentioned before that's one that it's the first time we've added to one of those large cap companies in a while. And that's because as we think about Amazon and the years ahead, certainly, once everybody starts reopening and going outside, that may affect the amount of groceries that you have delivered from Amazon. But all of those Prime members, a large chunk of them are going to stick with Amazon, and that provides the durable benefit that we're interested in. So that's an example of those conversations that we've been trying to figure out among the portfolio. And the second appeal of consumer right now is that we think that with the election results and a vaccine rolling out across the country, the setup for the consumer is pretty good for 2021. GDP growth is set to accelerate. We know interest rates are low and they're going to remain low for a while, and we may well have another stimulus bill. So that overall backdrop makes for a pretty good picture for consumer in the year ahead. So we've been thinking about where we might add value in that way as well. In terms of risks to the portfolio, you know, I almost think this is going to sound strange, but I hope we don't have it. But any kind of reclosing can't be taken off the table, because certainly that would keep tech and momentum continuing to work, because it would delay the reopening part of the equation. And I think our portfolio remains more diversified than clearly just being a tech fund. So that is something that we think about. The other risk in the portfolio that we want to just be sensitive to is it's not so much inflation that we're seeing signs of, but we just want to make sure we understand the yield curve and the impacts of a steepening yield curve on any portfolio names that we hold. And so that's where a way that we've been thinking about what's the impact of a steepening yield curve on anything that we own, and what might that mean. Again, I think some of the diversification work that we've done and trying to not just own growth and momentum, that should protect us in that scenario, but that is still a way we want to make sure that we really understand, if we do have that kind of shift in leadership, that we're well positioned for that.
Peter, any closing thoughts from your side to build off that nice summary from Margaret?
Maybe just adding some. Let me weave in some anecdotes from the first part, where this is an extremely overbought market. There's no question about it, right? Speculation is frankly at all-time highs. I'm certainly not suggesting that's our core operating thesis, where we shelter assets and we go to cash. That's not that at all. I'm just suggesting that this is a market where a swift 15% correction is likely, and what I would say is we are prepared for that and anticipating that, and you'll see movements within the portfolio where we end up beefing up or adding to new positions as valuations become a little bit more in check. So 100% agreeing with Margaret here. We're watching everything, but and it might be just a black swan event, but there will be a period, right, where we get a significant drawdown, perfectly natural, and you'll see and you should expect an awful lot of activity from our side.
Great. So we're right at 45 minutes. So why don't we kind of wrap it up there? To those listening live, or on what will be the replay of this call, we just wanted to thank you. I'm sure each of you, including the three of us, are all going through various stages of virtual meeting, conference call fatigue. And our partnership with you and your clients is what sustains our business. We genuinely hope you found this call useful. And don't hesitate to give your client representative, whether at ClearBridge or our parent company, Franklin Templeton, feedback on how to make our future calls even better. With that, thank you and have a great day and a great 2021. Bye now.